And we've got in the studio our very own business and economics editor, Halligan. The Cabinet talking about interest rates today, aren't they?
Absolutely, and I'm sure they will be nervous ahead of tomorrow's inflation number at 7 a.m. tomorrow.
Right.
I'll be here in the GB News studio. That inflation number for May, it isn't an exaggeration to say, Andrew, I would say Rishi Sunak's the trajectory of his premiership depends on that single inflation number, the consumer price index. There'll be other data around which nerds like me will be interpreting: food price inflation, core inflation, the producer price index, which points to future price rises. If that inflation number is currently 8.7 in April, 4% in the US, 6.1% in the Eurozone, if our inflation number still starts with an 8, then we're going to see a big interest rate rise from the Bank of England, possibly 0.5% up to 5% in one bound, and it will dominate Prime Minister's Questions Time. It will dominate politics for the next few weeks and months until the next inflation number comes out.
And Rishi came in, he was going to sort this out.
He was going to sort this out. He was going to sort this out. He made it, he made a pledge to halve inflation by the end of the year, and lots of people said, oh, that's so easy, that's going to happen anyway. It may happen, but even if it is 5% by the end of the year, that's still more than twice the Bank of England's target. Yeah. And we're not talking about price falls, Andrew, when inflation comes down. We're talking about prices going up less quickly.
Yeah.
So the cost of living squeeze eases, but it doesn't reverse.
And for people with mortgages, Liam, there are some eye-watering figures knocking around at the moment when you talk to people. I was chatting to some people this weekend. It's like, well, it's just gone up. I've come off my fixed rate and it's quadrupled. Let's have a look at some of these numbers, because I've got some GB News graphics here, and radio listeners can bear with me. Let's have a look at these interest rate rises that we've seen. So that goes all the way back to 2017. Interest rates well below 0.5%. They stayed ultra low throughout 18, 19. Then into lockdown, they went all the way down to 0.1%. So between 2017 and 2020, you can see there rates were ultra low. And it's those 5-year, 3-year and 2-year fixes, which are now expiring. They were made during that ultra low period. From late 2021, early 2022 onwards, 12 successive interest rate rises. You see that staircase all the way up to 4.5%, and now we're expected 4.75% on Thursday, or even 5% if the Wednesday inflation number is particularly chunky. What does that then mean for mortgage rates? We can then push on to the next graphic, and you can see back in June 2021, the average 2-year fixed-rate mortgage on an average loan-to-value on the average home in the UK, 1.91%. Just to interrupt you 1 second, just to remind us, that was when there was also a stamp duty holiday.
That was also when there was a stamp duty holiday.
So people were overstretching themselves a little bit and getting enthusiastic about buying.
Indeed, but also the stamp duty holiday itself pushed up house prices because sellers knew that people had a bit more in the tank because they weren't having to pay stamp duty.
Yeah.
That's why these stamp duty holidays, in many ways, are counterproductive. So 1.91 in June 21 there, Bev. February 2023, 5.07, the average 2-year fixed-rate mortgage. Now 6.01. These are the average numbers. So you're coming off like 1 or 2 or 3% mortgage if you have a 5, 3 or 1-year fix, because of the rates from 2017 to 2020, and you're going from 1, 2 or 3% to 6%. And Liam, your interest payments are doubling.
And in terms of the average mortgage, what is that going to go up from and to?
Well, funny you should say that, Andrew, because I've got another slide.
I thought you might have.
And here we are. So this is the mortgage squeeze. The average mortgage payment on the average home is going up as people come off fixed rates from £759 to £956. Again, these are averages. Yeah. So there'll be many people in there who've got massive equity in their house.
Yeah.
If you're at the kind of, early stages in your life, you've got maybe you've got young children, you've had to stretch yourself a bit to get a family home, your increases are going to be a lot higher. And just before the slide went off there, I added up those incremental mortgage increases per month. On average, as you come off those fixed rates, an extra £2,500 a year after tax. For anyone, that is big money.
They did furlough, they did all sorts of schemes to help people during the pandemic. They're not going to help any families struggling with their mortgages or families struggling with their rent, are they?
I tell you what I think is going to happen.
Go on.
and I've been reading about this, what happened in the 70s when there were big mortgage crises, what I remember from the 80s when there were big mortgage crises. And by the way, people say, oh, interest rates were 15% back in the 80s. The kids these days, they eat too many avocado sandwiches. No, that's not right, because the kids these days have much higher debts because the houses have been so much more expensive.
Yeah.
But what's happened in the past is, rather than massively upping your payments each month, mortgage companies, to avoid eviction, say, I'll tell you what we'll do, Bev. You've got a 25-year mortgage. Make it a 35-year mortgage, and we can keep your payments roughly where they are, OK?
Right.
And then when rates come down again, we can take your mortgage back to 25 years. That's one thing that you can do. What you can also do is move from a repayment mortgage to an interest-only mortgage. So for a year or two, you're not paying off the principal loan, you're just paying the interest. I think what we'll also see, we'll see a return to housing practices maybe that seem a bit old-fashioned, a bit Mr Rigsby and Miss Jones and Rising Damp. You know, lodgers. I think people will start taking in lodgers.
Yeah.
What I
I think,
did in the 90s.
And I think if I was advising Rishi Sunak now, I guess that, you know, that ship has sailed. His choice. If I was advising Rishi Sunak now, I'd be saying, if people take in a lodger, you don't pay tax on that. Forget about it. Just give people the incentive to take people in, earn a little bit of extra money. But look, there isn't a house price crash yet. I do think house prices will correct a bit, which younger people will be happy about. Maybe they've got a chance to get on the housing ladder. There's a fundamental lack of supply of homes in our country, so I don't see a massive reduction in house prices, but I do see a lot of pain for particularly younger couples who've taken out a mortgage, are now coming off those fixed-rate deals, having to remortgage at a much higher rate. And that pain will dominate politics for the next 2 to 3 years.
It's dominating people's lives. Liam, thank you.